This is Pre-Market Prep. I'm Brianna Valesky in for Joel Elconin. I'm joined by Jill Malandrino. She's the Product Development Manager for OptionsProfits at TheStreet. In addition to managing that product and content for the website, she's a market site reporter for the NASDAQ, reports from the floor of the CME and CBOE, and hosts a morning call for TheStreet and the all-in-one video for Options TV. Jill, I know you're a busy person, so we really appreciate you joining us on the show this morning.
Of course, anytime. Thank you.
So we are in the approaching the heart of earnings season right now. What are you seeing in the overall market?
Well, I think earnings is a welcome break for traders who are just completely exhausted from macro headlines. If we take a look at the S&P from the beginning of the year, it's up almost 2%. And if you break it down on a weekly basis, there are some weeks, just like we saw last week, where it is literally flat from Monday to Friday if you just look at the start and end points. But obviously there's a lot that was going on underneath the surface, a totally different story entirely. So I think now that we're getting into earnings, it gives traders something else to focus on from a more fundamental perspective versus what's happening in Greece, interest rate hike speculation on our side of the pond. The Chinese market is in complete disarray. There's a little bit of support there now, but it doesn't feel as if there's a long-term fix in there. And, I just think it gives the market something else to focus on. Some key themes that I'm looking at for the quarter is going to be revenue, because I think what we've seen over the past couple of years is that companies have been making their earnings via cost cuts, and that's just really not going to cut the mustard this time around. So revenue is definitely going to be key. The U.S. dollar strength and what's happening with the impact on FX is obviously going to be something. Interest rate hikes, of course, that's still going to be in the picture. I just want to remind everyone that Janet Yellen will be giving her semi-annual reports to the House and Senate Financial Committee, so there will be some analysis around that and speculation on the timing based on what she has to say. And of course, Greece and China are going to be in there for the quarter as well, but I really think when you look at it in terms of domestic earnings, revenue is going to be key. I think consumer spending in the housing market, they're also going to be key underliers to gauge the strength of the U.S. economy. We saw retail sales out this morning down 0.3% versus expectations of up 0.2%. Not that great there. In terms of the big banks, Wells beat. They missed on revs. JP Morgan had a great quarter, beat on earnings, also beat on revenue. J&J is another one that came in. The quarter looked pretty good, and we're listening to the conference call right now. I'm surprised to see the reaction that it's up a little bit now, but that it's had from the earnings print. So I think it's really going to be the type of quarter where if expectations are incredibly high for a company going in, like we saw at Wells Fargo, there was a lot of love going into that print, and unless you beat substantially and you guide really well, I don't think stocks will react well. And conversely, on the other side, if expectations aren't that high and you come out with a great beat and you're guiding well, you will certainly be rewarded. The other thing we have to deal with this week, we have regular way options expiration this Friday, but I think you'll see the bulk of that action in terms of rolling positions and so forth on Wednesday and Thursday is really when you're going to see a lot of the activity there.
Yeah, I'm so glad that you brought up Wells Fargo. It seems like even with JP Morgan coming out with good earnings, it was kind of the whole financial sector is being pulled down a little bit by that Wells Fargo report. And that's a lot of what we saw last quarter even too. It's like if there were high expectations, unless you really hit it out of the park, investors didn't like it that much. So I wonder if that's just kind of a foreboding of what's to come for the rest of earnings season. And I'm also glad you mentioned Johnson & Johnson. We have their chart up right now looking at the stock overall. I think did they raise guidance as well?
For what did they do? Yeah, they came in on the revenue for this quarter. They actually came in slightly ahead of consensus. They raised their full year guidance from 610 to 620, from 604 to 619. So it looks like they just brought up the bottom end of it. But, they were in line or slightly higher beats. They did really well with it. Their actual earnings beat was due to higher gross margin, which is a great data point. So even the action leading up into it, I'm surprised to see that it hasn't had more momentum. So we actually have a position on in the options portfolio. We have a call spread on there. So we'll definitely be paying attention to this one. I think in addition to being a well-recognized consumer staples play. They do have that brand recognition. It's a great med tech company, and they're also building up that key pharma business, which is really where the growth will come from. So it's doing everything it's supposed to do. So this could be a gift here with the little dip. And, we happen to like the shares. We own it in Action Alerts Plus, which is Jim Cramer's charitable trust, and Action Alerts Options, which is the options portfolio overlay on it. So we're bullish from a stock perspective, and we have a directionally bullish biased options position on as well.
Yeah, definitely. Taking a look at the chart here, it looks like it was already a bid almost, or if not all the way up to the $101 level, and then trading down now around the $98 level. But we'll have to
Right.
see once it gets where it gets once it hits the open. Another stock that you brought up earlier before we got live on the show that will be reporting earnings tomorrow afternoon, Netflix. I mean, this is a company it's just a beast. It's beat on the last 4 quarters of earnings report. EPS estimate around 30 cents, revenue estimate around $1.65. What are your expectations for Netflix?
Netflix is interesting, and it's actually the best performing stock in the S&P 500. It's up 108% year to date, and the next closest is Electronic Arts at 57%. So when you
I
say
didn't
it's a
know that.
beast, obviously the fundamentals are in line. The chart seems to confirm that price action. Fundamentally, analysts continue to see significant global growth potential over the next several years. Several sell-side analysts took up their price targets over the past few weeks. And also remind everyone that it trades that 7-to-1 split, the post-split on Wednesday morning. And you just have to be careful here because the valuation doesn't change just because the share count is a little bit different. I think there's that perception that's out there, but we just want to remind everyone that fundamentally, it hasn't changed any of the metrics there. I think what the key here is going to be domestic and international subscription guides because expectations are really high for growth internationally. And this might be a little bit basic for the traders on there, but we have a lot of OptionsProfits and Action Alerts options subscribers from my sites participating on Benzinga this morning. So when we look at stocks like a Netflix that have huge implied moves, if you look at the options market going out to it reports on, what do they report on Wednesday? But if you take a look at the implied move out to Friday, which is actually options expiration, it's almost pricing in a 15% move. That's a big move. So you have to ask yourself, what's your directional view? What are your expectations out of the earnings print? What are the implied moves relative to the historical moves? And right now, even though expectations are quite high for the stock, it is pricing in, an implied move that is 3 to 4% higher than its historical. Typically, when you're looking at big vol moves, you'll see traders put on straddles and strangles, but because it can be so expensive in the case of a Netflix, traders that we speak to, some suggestions that we even made on Action Alerts Options is to just put on a basic spread based on your directional bias, whether it's, you're buying a call spread or you're buying a put spread, whatever your direction is how we would do it, so you can at least finance your purchase with the sell side of the position, because it can be incredibly expensive if you were to do a vol play, whether you're buying or selling a straddle or a strangle. And in this market where we're so married to macro headlines, in addition to the volatility that Netflix prices in, that can be a really expensive proposition if you just do a straight vol play. So we're recommending, based on your directional bias, just straight up debit to call or put spreads on Netflix.
Hey, I love how you said that we're married to macro headlines. It's a great point to make as well.
I know,
That's
right?
so perfect. It perfectly
I think that's why,
describes it. Yeah.
well, I think that's why so many people are looking forward to earnings, because it's something else to talk about.
It's a
Where there is,
relief.
if the stock does well or not on earnings, it's more substantial for traders to do something with that information versus for the past 3 weekends, everyone's focusing on what's happening with the futures on Sunday night based on headlines that are coming out fast and furious out of Greece. That's really not a way to trade when you have positions on. So then you have traders who are buying. There was a huge run in the market on Monday, but how could you not go into Monday without having some sort of protection on? You'd be crazy not to. So those positions aren't doing well because everything, again, is so married to what's happening on the macro level. So I think earnings are going to be a welcome change. It's almost funny to sit and say, I have Netflix on, it's going to move 50% one way or the other, but at least it's different than, dealing with arbitrary headlines out of Greece. It just sounds so crazy to say that.
Yeah, absolutely. Well, you mentioned a couple sectors you were looking at before we got live on the show, and it's kind of, it was great timing for you to mention consumer staples because our last guest was just on the show saying that things like, discount retailers like TJ Maxx and Ross stores were showing up on his radar. So I would love to get your take on those right now.
Right. So we actually spoke about TJ and Ross stores back on May 16th when I was on, and TJ was trading around 66, and it's let's see. Time flies when you're on the radio and the market opens.
Right.
And it's just over 69 right now. So that's a nice little move for just about 22 trading days. And the reason I like TJ is if you look at the consumer discretionary sector, it's always a tape of the have and the have-nots. And I think the discounters like a TJ, like a Ross stores, it's another interesting chart to take a look at. These are solid consumer discretionary names. If you for longer term positions, they tend to be more conservative than single brand retailers. And the reason why we like the discounters, they don't have as much exposure to the West Coast port shutdowns, which could start to show up in some of the single brand retail quarters, particularly because inventory is a concern for single brand. But for like a TJ or a Ross, they could benefit from that because all of that inventory that was missed due to the shutdowns, it's going to funnel down to them, which could potentially help margins because they'll be selling these at higher levels than if they were already discounted with single brand. So that's one of the reasons that we'd like to take a look at these. TJ specifically, they've surpassed Macy's its last fiscal year in terms of hitting the $30 billion mark. They've delivered 25 straight quarters of same-store sales growth. The momentum is just here fundamentally, and it's fundamentally on the chart as well. It's trading really nice above its 15,200 day. So this is something that I'm going to take a look at. There is a lot of love out there, but it's reasonable. I think that the discounters are going to be the place to be sort of as we get through this quarter of earnings to see. It seems as if retail sales at the lower gasoline prices haven't really translated into anything. We're not seeing good retail sales data. Even same-store sales data has been relatively weak. So I think the discounters are really going to be the ones to sort of lead the way here if you have to look somewhere in the consumer discretionary space.
Yeah, absolutely. That's a great point, especially how it seems like those lower oil prices haven't, translated into everywhere in retail. But keep an eye on those discounted retailers, guys. We've also talked about so much retail in the past. I'd love to just revisit the retail sector right now and get a glimpse of what you're following right now.
Right. Well, you know what? A big thing for me in 2015 has been consumer staples, and I think I might have been a little bit early on it. I think M&A is really going to be what's key here, which is the reason why we own a name like Whitewave in the Action Alerts Plus portfolio, and we also have an options position directionally on that as well. They just happen to be in the right space of that organic health trend, and not only are they in the right space, they're also doing well organically. They're doing everything a young company should do, and they're growing. Conversely, it's also another reason why I love a name like a J.M. Smucker. And you know what? Admittedly, it's gotten beaten up a bit. I mean, the levels here, I think, are a gift, but they are also investing in areas where you're seeing growth, like pet brands. They just announced that $6 billion acquisition earlier in the year, and they are investing in the verticals that are growing. And these larger, more mature companies, we see with a name like a Tyson. Tyson's another one that we just bought in the trust, and we also just put an options position on that as well. These are relatively cheap stocks that are looking to get out of, for Tyson, for example, where it was using the word married again, very married to being a commodity company and involved in the chicken space. With the acquisition of Hillshire, they're looking to expand into other areas and be a complete consumer staples company. And I think we're really early in that one as well. So staples, I think, you can look at those larger, mature companies and the ones that are buying that have a decent balance sheet, they're paying healthy dividends, and they're involved with share buybacks and so forth, and they're using that cash to invest in the right verticals. That's really going to be your outstanding place. And then a name like a Whitewave, which, you know what, they're small enough to get picked up, but they're also big enough where they're doing everything right and they're growing. It's a win-win there. So I really think that there's going to be some interesting spots to pick here.
We're on the line with Jill Malandrino. She's the product development manager for Options Profits at TheStreet. Jill, we've only got a couple minutes left with you. Some final words of advice for our traders and investors as we go into the earnings season. We're going to be getting Google later this week, Yum this afternoon, Apple obviously next week. What kind of approach are you taking to the market, and what do you think would be a safe and kind of an intelligent way for our listeners to do it as well?
Right. Well, you know what? We've been, been talking about this for ever since Options Profits has been around for the past 5 years, that to always keep your positions manageable. Don't have so much on.
Absolutely.
The market moves way faster than you can, and to look for spots where you can get some cheap protection. It's like we were saying before. Even though it was a little bit painful to have puts on going into the open on Monday, it's something that you had to do. You have to be able to know what your risk is up front. Don't think of what you can make, but think of what you can lose so that you're prepared to manage the risk. That is the key for any successful options trader, and of course it applies to the equity guys as well. And again, because we are so exposed to macro headlines, really focus on the sectors that you know well, focus on the stocks that you know well, make sure all your fundamentals are in check and that you're really doing your chart work. You can't be one type of strategist or the other, and because you need to look at the charts and have a working understanding to see if the price action is confirming your fundamentals. I would, as always, keep position size in check. Make sure you have at least 20% cash on the sidelines. You never ever know in this market if you'll get a margin call or if you just need to have that cash. It's something that we've been doing in our portfolios, raising some cash to look for opportunities in beaten down sectors or stocks that have great fundamentals, but we have that cash to put to work when there is an opportunity, which are few and far between because, at the end of the day, the market still is on an uptrend. So you want to be ready when you do have those pullbacks to get into new positions, but you also want to be ready to make sure you have that cash to cover yourself as well.
Great advice from Jill Malandrino. A lot of the same things we talk about: risk management, technicals taking a backseat to fundamentals. So Jill's the product development manager for Options Profits at TheStreet. She joins us about once a month and always gives us a great look at just earnings season, retail sector, macro, pretty much anything we throw at her. Jill, thank you so much for joining us. It's always a
You got
pleasure to
it.
have you on the show.
Thank you so much. Talk to you soon.
Thanks.